Good day, my name is Bianca Hayward and I will be taking you through Aspen's stock review. Please do note that I will not be answering questions throughout this session. However, you guys are more than welcome to ask questions. You just type your question into the chat box and I will be getting back to you via email correspondence. So I'm going to start off with the nature of business. Aspen has a market cap of around $10 billion US. Aspen is the largest pharmaceutical company listed on the JSE and ranks amongst the 20 listed companies on the exchange. Aspen has 27 manufacturing facilities at 18 sites on 6 continents. Aspen manufactures approximately 24 billion tablets annually, providing high-quality, affordable medicines and products in more than 150 countries, focusing on niche therapeutic areas, namely thrombosis. Thrombosis refers to the formation of blood clots. Aspen's thrombosis products fit into the anticoagulant category. Aspen is currently the second largest provider to the European injectable anticoagulant sector with 15% of the sector's share, and the third largest participant in the total European anticoagulant sector with 10% of the sector's share. Aspen also focuses on anesthetic, specifically the newly acquired anesthetics from AstraZeneca and GSK. The newly acquired acquisitions positions the group as one of the leading providers of anesthetic products worldwide, and the group holds approximately 20% of the market share in this therapeutic category globally outside of the US. The group also focuses on high-potency products and infant nutritionals. Now moving over to the geographical split. Emerging markets is expected to account for 51% of the group's 2018 sales. Traditionally, the group has been more emerging market focused. However, more recent acquisitions has resulted in developed market accounting for almost half of the group's revenues. Group revenue by geography. Western Europe is the group's largest division and is expected to account for 31% of the group's sales, followed by South Africa, which is expected to account for 21% of the 2018 sales. These two divisions make up more than half of the group's revenue. Now moving over to Aspen, or about Aspen. The group has a strong market position and is one of the largest pharmaceutical companies in the Southern Hemisphere. The group has a substantial presence in major developing markets such as Russia, Eastern Europe, Sub-Saharan Africa. The group is also one of the top 5 pharmaceutical companies in Australia. The group operates across diverse geographies and has a wide product range. The group is well positioned in both developing and developed markets, with products distributed in more than 150 countries. The group also has an established presence in 50 countries. More than 80% of Aspen's revenue is generated outside of South Africa. The group's centralized activities facilitate synergies and helps the group mitigate pricing pressure. The group has a solid track record with a compound annual growth rate in excess of 40% in both gross revenue and EBITDA since listing in 1998. The group provides high-quality, affordable medicines and products to historically underserviced markets. Aspen also operates in the pharmaceutical industry, which is considered defensive in nature. Aspen does not have a specific R&D unit and aims to grow its portfolio through acquisitions. The group remains optimistic about growth in hormonals and biosimilars. In 2016, the group launched 92 new products in 22 countries, mainly in the group's therapeutic portfolio. Aspen's product pipeline as of 30 June 2016 amounted to $4.8 billion US, with 50% of that expected to launch within the next 2 years. Aspen believes there's opportunity to consolidate its position in the anticoagulant sector. The underlying dynamics of emerging market health demand are strong. Now moving over to the performance graphs. The graph on the left, we can see that revenue over the 10-year period grew at a compound annual growth rate of 26%. Consensus expects the full year revenue to amount to $42.7 billion, representing an 18% increase. Consensus also expects the 2018 financial year's revenue to be up 11%. Growth in revenue will mainly be driven by Asia Pacific and Latin America. And in terms of product lines, growth will come from newly acquired anesthetic business. Organic growth, however, is expected to remain muted. Now moving over to the graph at the right. Operating margins is coming off a low base. However, margins is expected to remain under pressure as the group is likely to continue to face pricing pressure. Margins in the API and FDI division is expected to improve on the back of synergies realized at manufacturing facilities, procurement improvements, insourcing, the shift of manufacturing to low-cost sites, and labor cost reductions. Now moving over to the next graph, normalized headline earnings grew at a compound annual growth rate of 21% over the 10-year period. Consensus expects the full-year normalized headline earnings to be up 15% and the 2018 normalized headline earnings to be up 20%. Then the graph on the right, the group has also identified several self-help opportunities to improve margin and EPS. The successful integration of acquisitions will prove key. Now the graph on the right, consensus expects dividends per share of 280 cents per share, representing a 13% increase. Then consensus expects the 2018 financial year dividends to amount to 331 cents, representing an 18% increase. Now moving on to the next slide. On this graph, we can see that Aspen's 1 and 2 year forward earnings has consistently been downgraded. Aspen's been facing pricing pressure, a stronger rand, and weak emerging economies. The anticoagulant franchise, which accounts for 15% of the group's sales, continues to underperform and faces threats from generics or biosimilar competition, whilst the newly acquired anesthetic portfolio got off to a solid start. However, it's too early to have much confidence in the group's trajectory of future revenues. The lack of product disclosure is also frustrating, and we question whether we will be able to accurately track these divisions going forward. Now moving on to the relative valuation. Aspen's 1 year forward revenue growth is ahead of its peers, mainly due to the group's acquisitions, while on a 2 year basis, revenue growth is starting to lag its peers. Aspen's 1 and 2 year EPS growth is ahead of its peers, benefiting from self-help opportunities and strong growth on a 1 year basis. Aspen's return on equity is well below the median, and Aspen's 1 and 2 year forward PE seems to be trading at multiples below its peers. However, it is important to notice that the group's price-free cash flow is significantly higher than its peers, translating into our concerns about cash generation. Long lead times on complex API translate into longer than normal working capital cycles. Now moving over to the relative valuation. Aspen is trading at multiples slightly below its generic peers and at multiples in line with its long-term averages. Looking at the period of high multiples, we believe that is due to the expectations of the success of the group's MMA strategies. The group's MMA strategies is not easy to track over time, and we believe that the GSK anticoagulant, OS and MSD product deals has not delivered as expected. Now moving over to the next chart. On this chart, we can see that the return on invested capital to WACC has consistently declined over the past 10 years, making us question whether it's sustainable to trade at a premium. Now I'm going to move over to the recommendation. The underlying dynamics in the emerging market health demand are strong. Historically, the group's been very strong at mergers and acquisition and delivering synergies from purchased assets. Recent acquisitions is in line with the group's strategy to focus on therapeutic areas and move away from areas where the group believes that they are less able to add value. Recently acquired anesthetic portfolio presents an opportunity to leverage the existing hospital-focused sales force. The anesthetic and thrombosis products from GSK provided the group with an opportunity to expand into China. Aspen will work on optimizing the contribution from various sales teams deployed. The group's 2.5 billion cost-saving program remains on track, and the group has realized 500 million or 80 to 90 cents of the R4 so far. The group expects to realize another 500 million in the second half of the year and the remainder in the 2018 financial year. Aspen will also launch a number of high-margin products in the US over the next 24 months. In South Africa, record profits is expected as the group bounced back from its manufacturing issues, which impacted the results over the last 12 months. This provides potential for further upside, and the group believes that the stronger rand and SEP price increase is also further potential for upside. Now moving over to the portfolio guidance. Based on the group's relative valuation, we feel that the group is fairly valued, resulting in our neutral positioning relative to the benchmark. Given the benchmark weight, we would recommend portfolio guidance of up to 2.57%. Major concerns remains the group's poor cash generation and declining profitability. It is important to notice that there is a few risks to our valuation, namely, more than 80% of the group's earnings is generated in currencies other than ZAR. Accordingly, the group is exposed to currency volatility. Aspen has made a number of acquisitions in recent times. The integration of these acquired businesses could prove to be tough. It also places strain on financial and human capital resources. The group could face pressure from slowing emerging markets. Aspen is also exposed to ARVs. A slower rollout of ARV drugs in South Africa could impact the group. Pricing in the private ARV market could also come under pressure going forward. Government or funders' ability to pay remains constrained, which would even place further pressure on margins. Healthcare systems around the world continues to face a cash crunch. High levels of government debt and healthcare funding pressures in Europe, Aspen's largest market, makes further cuts to drug prices inevitable. A large number of European countries have low levels of generics. That's a potential upside. However, it is easier to cut drug prices than nurses' wages, particularly the prices of generics. Recent articles on Aspen's cancer pricing also bring unwanted attention to the group's pricing tactics. The South African Department of Health has issued new guidelines on pharmaceutical pricing, including international benchmarking. These rules could yet have a material impact on Aspen. The UK's new Health Services Medical Supplies Bill, if passed, will allow government to impose lower prices if they believe generic pharmaceutical producers is abusing market dominance. Given the fewer opportunities to hold or raise prices, it is likely that Aspen's 2.5 billion synergy target would not be realized. Evolving pharmaceutical regulation also continues to raise the cost of compliance, and product registration times are unpredictable, affecting the supply chain's readiness to launch products. Low-cost Asian pharmaceutical companies has been active in all major territories, with many competing generics being launched upon patent expiry. And there is also the threat of potential or the introduction of biosimilars. That concludes my webinar. Please feel free to ask questions. Please type your questions into the chat box. And if you'd like to place a trade, please contact our trading desk. Thank you and enjoy the rest of your day.